Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Econ Show, we have a lot of things to cover now that we've had the emerging market issues that we've been talking about with rates, global yield. What does that mean going forward? Then we turn to the US. There's been some mixed data points. Some of it's really good. Some of it has been soft. And how much of that is weather related versus a real kind of softening of the future. Then we're going to turn to the worker and the shift to work from home, the consumer. What does that mean for real estate? What does that mean for the future of just where are you going to do your job? And then looking at Europe, as we start to see, March we had some positive data moves, but those have started to come down, going through that a bit, and then turning to China and Asia in general, looking at some of those data points as we do have some COVID cases coming up and some issues on Chinese growth and what does the Chinese economy really look like as we go through the remainder of the year. So before we get into this EM sovereign spreads versus oil prices, it's just to kind of, we film the EIA show and Econ show on the same day. So some of the data points come out at different times. One of the ones that just came through when we look at, so right now, U.S. gasoline imports from, or I should say European exports, are at the summer of 2019 highs, in terms of where we have additional flow. We have more diesel coming into the U.S. markets, and then we have more super tankers that are coming from Asia into Europe. So again, we're getting these shifts overall, and it really, the reason why I say this and what made me think of it was looking at this chart. As we said in the EIA show, this was going to pop up again, the sovereign spreads versus oil prices, because spreads have continued to go up, and in the middle of February, towards the end of February, we showed what the Bloomberg economics team has done and then put our own little twist on it by looking at what has happened with rates and what would a shock of 1% or 100 basis points, 200 basis points due to not only GDP, but also stimulus, what fiscal, monetary. And we're starting to see that. And we're starting to see just how problematic some of these moves are, especially when we look at Turkey and how that has had a residual effect, because Spain's has the biggest exposure to Turkey. Russia had to pull their bond offering. As we discussed with Damian Sassower, we went through, what is happening abroad, like how bad is it? And we continue to see that it's problematic, especially in some of these big countries like India, China, that are not only just large in terms of GDP growth or what the expectations of GDP growth are, but also oil consumption. And this is where we start to see some of these pressures, whereas oil prices have gone up. India has seen the headwinds in terms of consumption, but as EM spreads increase, it's going to hurt stimulus. It's going to hurt their ability to borrow, because we have other charts later on showing just what does that mean for total flow, and what does that mean for interest expense when we compare it to U.S. versus or developed markets versus emerging markets? So just doing a quick overview, because I think these are good charts to show. Just looking at what has the U.S. 10-year done, you can see that it's still in its upward trajectory. It's obviously doing some work here. The 30-year has pared back a bit. But again, it's still within this kind of this new setup or this new normal, just because we've had some cool off with some of the economic data points with durable goods, some of the real estate numbers. So some of the inflation rhetoric has pulled back a bit, but there's still some growth intact. There's still some movement in general. So again, this is a more upward trajectory in just as we go through the remainder of the year. Then as we start to look at this a little differently, when we look at the inflation, the inflation one is still moving in the upward move. Inflation rate is still moving up. So you can see that the 10-year is the big correlation we like to look at, because typically emerging markets, as we discussed with Damian, there's a duration fear. So would you be willing to give India or Russia or Brazil money for 5 years or 30 years? 8 years or 15 years. And that's why the 10-year is kind of the long end of their curve. So as our 10-year goes up, and then we're, the risk-free rate, if you will, they start to get ratcheted up against that. We saw that with the rupee. with the ruble. There's some fear, which is causing some of these rate increases, or, Brazil increased rates. So that's where you have to start managing inflation. And if you start essentially, instead of easing monetary policy, but tightening policy, you're taking some of that liquidity, some of that stimulus out of the market, and you're going to really pull back some of that these GDP assumptions, which is why coming into 2021, we kept saying, what are people looking at? Like, clearly, obviously, based on the data we're seeing, we're more on the bearish side, but some of the stuff has been crazy, and now they're starting to roll back some of these estimates, and it doesn't, they never made sense really to begin with. But now that we're starting to get into, some of these rising rates, and this is where we come into what is the Fed going to do with the SLR? They've talked about that expiring. What is that going to do for the near-term overnight side? Is this going to open up some yield control? Because you can see right here that we're holding at 0% in the overnight repurchase market. You can see the moves in the 30-year maintaining that trend, doing some work here as I think we go to the next level. But again, that near-term side is just showing that there's fear in the market. There's a certain amount of concern. So you're leaving stuff in the money market account. Now you have stimulus coming through. People are going to put that into their savings/money market account, putting additional pressure on the lack of paper in that overnight short-term theater, which again is causing some friction in the market when you look at just where is the yield curve, what does that mean, and then what is that going to be indicative of in terms of Fed policy as we head into the next few months, which will be dovish, but how dovish? So then when we look at rising yields, so we've talked about this in the past, when you look at forward PE, so what do rising yields mean? It means your weighted average cost of capital is going to go up. It means that you have which is just in terms of your borrowing, but at the same time, there's a certain amount of inflation that's involved. What is moving in the system? What are your prices received versus your prices paid? And there's only so much of that prices paid you can actually push to the consumer. So your margins will compress, your revenue will compress. And that's where, or I should say, profits in general are gonna see some struggle, and that's gonna weigh on that PE multiple, which is why we think that this is going to start to roll over. Now, I don't want to take everything from Macrobond and Nordea, so you can see this is I think a very good article that they put out in front of their paywall, because I think it does a very good job of highlighting some of the friction points and how a lot of these equity moves have really started to really kind of move further over their skis as we see these yields continuing to press higher. Now, when we look at the dollar strength, this is one of the things where we were a bit more bullish the dollar than I think everyone else, and it was really looking at some of these underlying components, because if you expected growth, if you expected a lot of this movement, well, you were going to get a move in yields. You were going to get a move in yields, and what is driving that? And we have charts showing that. But again, this is also going to be a lot of dollar strength. Now you have the euro weak, Europe, data weakening just in terms of COVID, Asia struggling, and again, that's pushing the dollar higher because you're seeing bond yields go up. So if bond yields go up, the carry trade starts to open up. If I'm in Japan, what is my carry trade? If I'm in Europe, what is my carry trade? And I have to buy dollars to purchase treasuries. So that inherently puts a bid into the US dollar. Now, do I think it goes to 96? No, or at least not yet, or in the near term. 92.60 was kind of like where we were thinking for that near term stop as we continue to kind of approach that, just as we see some of this movement on growth expectations over the next 12 months, which is, you can kind of see it normally kind of pulls this higher. So shifting a bit into the emerging market side, this is where we continue to see these problems when we look at oil demand, refined product demand. Emerging market manufacturing PMI is starting to roll over. And when you look at the cuts or the average hikes and cuts, we're starting to see the hikes now. We're starting to close this gap, as we saw with Brazil, as we saw with Russia, as we saw with what we think is going to happen with India. So that's where you're going to continue to see these cuts, which will continue to cool some of this PMI. Then you have, layer on top of that, PPI increases, CPI increases. just demand struggling in general, with India, for an example, at 5.1% inflation, very much elevated versus where they were hoping. They were at 4%, which is right kind of on target, now pushing towards the top of the range. Turkey has seen their inflation increase. I mean, Argentina is at 67%. So you're really seeing this push, which is really going to pull these rate hikes higher and kind of tighten, or at least pull down some of that PMI data. And I thought this was a good chart looking at that undetected inflation. And we've talked about this a lot. And, I cheat to use a Snickers bar because one of my marketing professors showed us a story of, how can you market something and what is the consumer going to recognize? So he had pulled out a Snickers bar that was an old Snickers bar from 1995. Then this was in 2005, and he took one out from 2005, and he's like, clearly you can see the difference. The one within 10 years, the Snickers bar had shrunk, but the price had gone up. So it's like, all right, well, you're getting less for your money. Now, and it's funny because he always taught us, make sure to look at the ounces you're paying for. And when you just look at the compression on the size of what you're getting for the money that you're spending, and that's why like Ben & Jerry's whole marketing shtick is, still a pint. Well, it's also $5.99 versus $2.59. And yeah, you can get it on sale, but retailing at $5.69 versus $2.69, a $3 increase over 10 years, just looking at that in general. Then you look at Barilla pasta, how much of that is now no longer a pound. You're starting to see some of these movements that really can get hidden with, or embedded in. You're just getting a unit price is going up, and that's where you start to look at some of the benefits. So clothing has gone down, but now we have cotton going to highs. We have supply chain disruptions. So transport, you look at food. The one problem, and this is going to hit people differently, food continues to go up. That is the crux of what we need on a basic needs level. That is going to be the biggest driver and problem as we go forward. Because recreation, restaurants, hotels, that's been deflationary. I don't think anybody would argue that. But when you think about the food side, that is something that people rely on, and that could be the difference of you going to a restaurant once a month or twice a month. And these are the things. Now transportation is starting to go up when you look at gasoline, diesel. And housing is the one that is now shifting in the wrong direction and starting to continue to push higher. So again, there's inflation in some of these key aspects, and depending on where they are, it's going to have a bigger impact based on what was the starting salary, what are the wages and benefits in general, and then how much is there sitting in savings. So then when you look at the Turkish lira, just to speak to that for a second, Erdogan replaced the central bank chief, but look at what that did to the lira. Look at the pressure that put onto it. And this is what caused Russia to pull some of their offerings. India has been unable to clear an offering. The central bank typically steps in and starts buying. And these are the continued problems that we're seeing at the EM level. Now, when you look at the 1998 currency crisis and you think about how it was outside the U.S., but we still imported it eventually, and that it resulted in the tech bubble bursting and all of these other fun little nomenclatures. But emerging markets now is a much bigger part of portfolios. Now Erdogan is pushing people, the Turkish citizens, to convert from dollars and gold to the lira to provide support. I mean, would you take the risk? Like, do you think that's worth the risk? And that's where we start to see some of these problems. Now, the twin deficits is the one that we keep talking about, and I thought this was a good chart really highlighting it. Obviously, the Oxford economics team does a fantastic job. And when you look at the current deficits and the fiscal deficits in general, this is where we continue to see some of this pressure, where you're running a twin deficit in an environment where we have a record amount of debt, and the debt numbers are only going up in 2021, not down. So you have to roll your debt at a higher interest rate because obviously the 10-year's gone up, emerging market pressure. All the while, you're still running a current accounts deficit, which means that you're going to have to make sure to get out there and borrow because you're not getting those tax receipts. So here's where you can see just what those twin deficits look like. when you layer it against GDP, and if GDP assumptions are too high, well, that means the percentage just goes up. And again, this is what's going to continue to weigh on some of this recovery, specifically in the emerging markets. And then if you think about what is the long-term growth trajectory of oil, of gasoline, of diesel, it's always pointed to as the emerging markets, Africa, Asia. Well, this is what weighs on that. This is what cools that side, because if I can't feed my family, am I buying a car? And that's where the compression comes in, and some of this delayed reaction starts to filter down. So then when you look at the middle income countries, and what are they spending more than rich countries? So share of government revenue spent on public debt interest payments. So India is paying more in interest. South Africa, Indonesia. You can see all of these countries are paying more in interest. And as the 10-year continues to go up, that's going to weigh on what their interest expense are. So to give you an idea and put this in a little bit different context, you can see just the amount of annual interest payments at the developed market. So the developed market stock of government debt is obviously much higher than emerging markets because it's cheaper for them to do it. But now you're having the interest payments converge. And as they converge, they're just going to pull each other higher, specifically because as the 10-year goes higher, it's going to pull the emerging market interest expense up and obviously push also the developed markets up. So now as you get this kind of runaway move, now we're seeing all of these interest expense going up. And what does that mean? That means that you're going to have to cover interest expense. So that's less on Social Security, food stamps, social programs, or an increase in tax receipts. So if you increase taxes, you're taking money out of people's pockets, so they're going to spend less. So again, it comes down to this capping of economic growth as we continue to see this move. So the end of a 40-year bond bull market has a lot of ripple effect and impacts on a global scale when we consider of what does this economic recovery really look like. So then when we look at high interest rates and low growth, this is essentially exactly what we were saying, where high interest rates are going to essentially provide this overhang because the annual interest rate minus rate of GDP growth, there's going to be a lot to overcome to achieve some of this expansion. And just to give you an example of the U.S., where we were in terms of public debt, and then where our projections were and what actually happened. So you can see that anytime we're supposed to reduce debt, we explode debt. So this, again, just pointing to just the underlying problems of once you give someone a dollar and get them used to receiving that dollar, how do you take it away? Now, looking at this a bit differently, because as we talked about with the Russian central bank, they unexpectedly raised rates. It wasn't unexpected. If you looked at the ruble, if you looked at what was happening in the underlying markets, it was quite clear that a policy increase was coming. Now, the issue so far is the rates have been unchanged, but now we're starting to see some movements towards rate increases. And that's where we're going to, obviously the US and Europe remain, an overhang. But when we start looking at Poland, Eastern Europe, Hungary, Southeast Asia, that's where we're starting to see some of the pain that happened in Turkey, some of it that happened in Russia is going to start to whittle down and start to cause Latin America and Southeast Asia to start to act a bit differently. And this is what it means in general. So when we look at record high bond issuance in the U.S. So the left chart is looking at what is the bond issuance that we've seen, and January was at a record year. And when we look at the second record year or highest record year, when we look, it's either 2020 or 2021 straight through, because we're seeing just more and more demand for rates, because even though rates have had a strong move off the bottom, they're still at lows. So, or still at, obviously not the lowest ever, but still at rates that make sense. And now you have guys clamoring for yield. And here you can see just the U.S. high yield bond tenor has come into the 8-year mark. So now we're getting some of the longer duration in the high yield space, because if I can, why would I own India at 6.5% and be concerned? Or I can own U.S. high yield debt at 5% and not have to worry about conversion rates and movements back and forth and restrictions on capital movements. So again, these are things that will keep and support some of this high yield movement and move some of that through. But when we think about bond yields or rate of return, this is when we start looking at rate of change. So even though yields are only just back to where they were, depending on which one you're using in 2020, 2019, on the percentage level, you're seeing the pressure to the downside as we continue to see the rate of change increasing in that time period and what is driving that. So when you look at what is driving the rising yields, there's term premium and then yield from path of interest rates. So we continue to see the term premium going up. And this is just, you're locking up my money. I'm looking around me. I'm hearing companies talk about inflation. I'm seeing PPI. I'm seeing my own bank account and the increase that I'm seeing in terms of just spending. I'm going to charge you more for taking that money. And that's where we start to see this movement, which is why I don't think that is going away and it's going to be supportive of these prices going higher. And looked at it at a different level. So the probability of inflation over the next 5 years is continuing to move higher, and it's going to be above 3% is what this is saying as we look forward, or is the probability of inflation over the next 5 years and averaging below 1%, which but more and more expecting above 3%, coming to why you're demanding a higher yield for giving them money overall. And that's why when we look at some of the worst drawdowns in U.S. history, here you can see the largest year-to-date drawdown in 15-plus year treasuries, and you can see that 2021 is near all-time highs because we continue to see some pressure, because we continue to see these issues in general as concern grows about what is happening with inflation and then that borrowing side of the equation, which is something that we're going to go through in more detail when we start looking at the U.S. and some of those U.S. data points, because there remains this concern in the market.